Hey everyone, Zach Silverman here. I hope you're doing really well. I just wanted to give you an update on the mortgage market and what's going on. We've had some really big changes, so this is going to be a little bit longer video than normal, but I'll try and keep it as short as possible. So the first big changes are a couple weeks ago, CMHC has changed the guidelines for insured mortgages. So people purchasing a home with less than 20% down, it used to be capped at a maximum purchase price of $1 million with a maximum amortization of 25 years. And we now have those guidelines expanded. So for first-time buyers or somebody buying a brand new construction home, you can now purchase up to $1.5 million with less than 20% down. So you can also have a 30-year amortization now to help a little bit with cash flow. So I'm just going to give you the information. There's good parts to it, and there's certainly negative parts to it. But in the email, you will see, of course, a breakdown of an example scenario purchasing at $1.3 million. The insurance premiums, which you always have when you put less than 20% down, are significant. At $1.3 million, they're close to $48,000 that gets added to your mortgage amount. With the minimum down payment, you're looking at monthly payments of over $6,000. So again, very, very expensive as far as payments go, but for the young professionals, people that just don't have the equity built up, but have significant income, it's a good program for those people. It's very out of reach for a lot of others. CMHC changes to insured mortgages is the big first one. The latest one, which is actually quite impactful, and I'm a really big fan of, is that our regulator, OSFI, has finally made a change so that somebody who's up for renewal in their mortgage no longer has to qualify using the Bank of Canada stress test, which we've had to for several years now. And what that means is that you can now, if your mortgage is up for renewal and you're switching to another lender, you can now do so and qualify at the contract rate. So it makes it more accessible, which just allows you to be able to potentially shop for a mortgage. Whereas if you couldn't qualify using the Bank of Canada stress test, which is contract rate plus 2%, which makes a significant impact in qualifying, you can now do so. So many people won't be as stuck with their existing lender with no options. As today, now starting in November, it comes into play. You can now qualify at contract rate. So that's a really good change. That's a competitive change that allows people to have more choice in the marketplace. Looking forward, where the market's at today, where it's gone, you're looking at my screen right now, and this is the bond, 5-year bond in Canada. You can see over the last 6 months, it just has continued downward. We're now at 2.758. And what this means is the fixed rates in Canada are priced off of the bond yields. And so as the bond yields get lower, fixed rates typically come down. There's more nuance to it, but there is a very direct correlation. And so we have seen fixed rates come down. We will see insured, so again, somebody purchasing with less than 20% down, rates getting closer to that 4% range, whereas not long ago they were in the 6% range. So huge difference there. What are we looking at going forward? The US has just done a 50 basis points, a 0.5% rate cut to their prime lending rate. That really opens the door for Canada to do the same in October. So I'm not saying that will happen, but personally, looking at all the data, I would say that there's a 75% plus chance of a 50 basis points rate cut coming in October. So that will affect those of you that have a line of credit, a variable rate mortgage, an adjustable rate mortgage. You will see your interest costs being reduced, and depending on your product, you will see your monthly payment reduced as well. With the main lenders that we work with, most of them you will see a monthly payment reduction, with the exception of TD Bank. TD Bank does it so that as the prime rate goes up, your payment doesn't go up, you just pay extra interest, and as it comes down, again, your payment stays the same, but you pay less interest, more to principal. So good news. It looks like we'll see some significant cuts moving forward through to the end of 2025. But again, there's no guarantees, there's no certainties. If what the bond market is telling us, we should see fixed rates continue to come down. So that makes the variable rate strategy a little bit more compelling now. you are still going to pay about a little over a 1% premium today in getting into a variable. So the reason why one would do that would be because you believe that the rate cuts are coming. If prime rate comes down by 0.5 point, that cuts that spread. And then the real reason, obviously, of course, is rather than locking into a 5-year fixed rate, for example, today at 4.25, maybe in 4 months, 6 months, that rate is at 3.75, and that will cost you significantly less over the term of your mortgage than just trying to find the cheapest rate today. So strategy, you'll hear me talking about it all the time. Strategy always beats cheapest rates today. So that's something that. The last thing that I want to touch on is our new mortgage management platform. We've teased you a little bit with this in the past. We've now rolled it out in a pilot type situation. We've got about 130 of our customers now on there. We're doing it that in a phased manner because there is some data, the inaccuracies, and so we'll just continue to clean that up as we go. But this is going to be a really, really awesome platform. So you can see here as I work through it, you're actually going to get the estimated market value using a really cool back-end software to give you recent comparable sales, etc., to come up with a monthly new estimated price and value for your home. You'll also have all your mortgage data in there. You'll have, this is a refinance opportunity. So you can see in this situation, they're at a 1.79% fixed term. This is just a dummy account. And so this is just going to give you the information. You says you have a great rate. If you refinance today, you'd lose around $35,000. So of course it doesn't make sense, but at least it gives you the data. It also will pull in your income, etc., from when we did the mortgage for you. And so you'll be able to see what you can afford, given your equity increase in your home as well as your income. And then lastly, if you were looking to add a line of credit, looking to purchase another home, this will tell you how much more you could borrow up to. And again, this is for illustrative purposes, but it's a really, really, really good tool for you to get every single month. You'll see the pay down, you'll see what's available to you, etc. So hopefully this has been helpful. Sorry for the long video. Tough to get it all in short, but hopefully it's valuable and you get some real value out of this. Chat with you soon. Thanks so much.